our virtual refresher course on direct taxes, and today's faculty is here. Ramnath B from Coimbatore has joined us. So, dear faculty, for this afternoon, C. Ramnath B, immediate past chairman C. Roy Varghese, past chairman C. A. Srinivasan, and our treasurer C. A. Allen, and other senior members and friends. So, the important subject: computation of business income, precaution, and recent developments. And we have none other than C.A. Ramnath V. I welcome speaker as well as all the managing committee members and participants to this third day of our refresher course. And I'm happy to introduce today's faculty, C.V. Ramnath. He's a BCom graduate and a fellow member of our institute. He cleared CA in the at Coimbatore branch level in CA final exams. Presently, he is a partner in Buses case for audits of various corporates and non-corporate entities. He also handled the appeals under Income Tax Act up to Income Tax Appellate Tribunal. He also handles corporate and non-corporate restructuring cases. He was a faculty for the CA Final Direct Taxes paper at Coimbatore branch for 17 years. He presented papers on direct taxes in seminars and conferences organized by various branches of the SIRC. He also addressed the students of various colleges on topics related to commerce, taxation, etc. He is also a member in the academic and governing council of various educational institutions at Coimbatore, Tamil Nadu. He was a member of the editing team of the books authored by Padma Shri Awadi Sri C.A. T.N. Manoharan for students on income tax law. With these words, I introduce our speaker for this afternoon, and I request sir to commence the session. Over to you, sir. Sir, you can come.
Chairman and other office bearers of the Ernakulam branch of the SIRC of ICAI, fellow members, senior members of the profession who continue to guide us. It's immense pleasure for me to be with you this afternoon session to share some of my thoughts on the topic assigned. Jose sir, am I audible? Hope I am audible, sir.
Yes, sir. You are, sir. You're audible.
Thank you. Thank you.
Yes.
Now, the topic given for our discussion this evening is computation of income from the head business and the controversies associated therewith and the recent developments in connection therewith. All of us know that in income tax law we have chapter 4 deals with computation of total income under 5 heads. In that chapter 4, this subchapter, namely chapter 4D, has got highest number of sections as compared to all other subchapters. And the presence of section 37, namely the residual section, provides scope for including items which are not spelled out in section 30 to 36. Therefore, it gives enough scope for more and more controversy. So long as a particular item falls under the ambit of section 37, one would be able to say that it is eligible for reduction. The restriction also comes therewith. Therefore, revenue also would like to say this is not something which is permissible. Therefore, controversies are more and more coming up. And whenever the views of the SSC and views of the revenue don't gel with each other and it gets escalated to the next forum, courts and tribunals started interpreting the provisions differently at different point in time. And one would not be able to say it is not appropriate to take a different view because wisdom makes people to think on different lines over a period of time and start thinking in a different line or a same set of facts as well. And that results in divergent views coming up. And sometimes when the judgments, orders to the tribunal come, which is not to the liking of the income tax department, and that is not really intention of the revenue or intention of the legislature according to the revenue, then the revenue attempts to make the change in the law, either nullifying the judgment or reducing the scope of the judgment, so on and so forth. And every finance act is not an exception to this. Sometimes the amendment would be prospective, sometimes the amendment would be retrospective, and sometimes the retrospective amendment will be made prospective by a subsequent amendment. Sometimes court will say, even though it is prospective, it is clarificatory, therefore it is to be regarded as retrospective. So therefore, confusions galore. Even if the amendment says effective from 1st of April 21, courts will say it is retrospective. If that amendment happens to be beneficial to SSC, SSC would be very happy. Though the amendment is prospective, courts have said it is retrospective. What is wrong in that? Sometimes the amendment may be prospective, but it will have a language saying it is always deemed to be. Then sometimes it will be say, and the amendment is such that it is introduced in the form of an explanation. Then the court would say some of the levels, at least at the tribunal level, when the issue started interpreting on it, court would say this is considered as a deeming provision, explaining the position of the law as it was previously, and therefore it can be made as declaratory, and therefore it is retrospective in nature. So these sort of interpretations on a law, which sometimes on a plain reading gives something, but at a later stage, when other facets of law is imported into that, then it is attempting to give a different reason. In that case, the law gets complex. One is getting slightly confused as to how one has to undergo or understand this provision. A simple example, section 50C, 43CA, 56(2), all originally had provisions to say where the value of the transaction of an immovable property, being land or building or both, transacted at a price less than its stamp duty value, it would result in taxation of the difference in the hands of both buyer and seller, so long as the buyer happens to be a person other than dealing in the immovable property, it is chargeable under 56(2). Whereas in case of seller dealing in immovable property, 43CA, if not 50C, either scenario. Subsequent amendment came to say we'll allow 5% variation as permissible. Then came 10% variation as permissible. Then came for a short window to clear the stock of the real estate developers. 10% is substituted by 20%. Now, these are all beneficial amendments. Law was very strict, stringent in importing a deeming fiction on a transaction entered into by SSC. Therefore, these relaxing provisions were considered as benevolent one. Therefore, even if it is prospective amendment, it can be regarded as retrospective. So even for past periods where appeals are pending, the gap is less than 10%. Why not we allow this? So now section says prospectively, but the judgment law or the judicial ruling say it can be regarded as retrospective, nothing wrong. So now, quite contrarily, other way around, in case an SSC has not deducted tax at source and that expenditure is otherwise claimed as deduction in respect of which tax deduction did not take place, originally law said will disallow this entire expenditure subject to certain exception 40 yes 1A. Then came, in case that 30% will be narrowed down to 30, that 100% will be narrowed down to 30%. Then came the other person has reported his income subject to other conditions being satisfied, no disallowance is warranted. These are on relaxation in the provision which were otherwise rigorous, troubling the SSC, putting onerous demand on the SSC. Therefore, these relaxations came. So the SSC attempted to canvass before the Honorable Supreme Court these relaxations are benevolent provisions. Even though they are prospective in nature, this must be regarded as retrospective, and therefore for past years also, right from the day 40A came into statute, all these current provisions should be applied. The other person has already reported income, you should not disallow mine. Though 100% was the original language, since subsequent amendment came to say 30, why not it be imported? But Honorable Supreme Court said, no, sorry, that is not acceptable. So now this sort of judge-made law comes up to say certain provisions are retrospective, certain provisions are prospective, even they are benevolent in nature. If they are not benevolent in nature, if they are prospective, it cannot be regarded as retrospective. If they are something which is putting additional responsibility, something which is putting into onerous responsibility, additional burden to the SSC, that cannot be regarded as retrospective. It has to be prospective. Even if it is made prospective, by interpretation, it cannot be made retrospective. But if it is made retrospective, can the court read it down? We have classic examples, number of examples are there. Lawmakers in their wisdom may say we are increasing the responsibility retrospectively, but with a conscious note, with reasons, etc. Court may come for the rescue and say we'll read it down. So even the language of the law is retrospective. The revenue argument may not find favor before the court of law. Court can read it down and say, sorry, to this extent, we'll say it is not retrospective, it will be prospective. Classic example, the definition of royalty as contemplated in the section 9.1 retrospectively came up. The latest February argued in March delivered Supreme Court judgment in the case of certain software payments said these retrospective amendments should be read down. It is not possible to do so. So these are all the judge-made law contributing to the controversies under this head. And unlike other provisions or other subchapters, this is one subchapter where more and more controversies are coming and more judge-made law also contribute for the controversy. Thereby, what happens now? Not only the reading of the text of law would be sufficient. What needs to be also looked into is the development in the judge-made law. How the law is understood, how the law is declared by the court of the country has to be understood. Also adds to the concept whereby mere reading of Barat or the commentary alone would not be sufficient. One has to also go to understand the judgment law and keep track of the developments taking place in the front of judgment law to make ourselves comfortable in the computation process of business income of an SSC. Generally, we need to make certain precautions to our mind before we enter upon nitty-gritties of the recent changes and developments. As professionals, especially professionals of this particular profession, chartered accountants, from very long period, several decades, we have been helping the SSCs in filing the return of income, and also we are issuing tax audit. So the Lakshman Rekha between issuing tax audit report and helping the assessee in preparing the return of income sometimes is lost. The devising line or the dividing line or the division taking place between filing the return of income and issuing tax audit report. That dividing line is very slender. Sometimes that is missed out. So we will have to make ourselves very clear. As far as the issue of the report in the statute, as required by the statute, we are doing a judicious job of doing the audit, ascertaining what it is, giving the report. We'll turn back and go back to the assessee's chair and start helping him in preparing the correct return of income. But that by itself should not give us an impression that in tax audit report we have to try to find out methodologies of giving a softened report. In coming to issue of a report, we are a fact-finding personality. That's the first exercise we are doing. We are fact-finding personality. We are giving this report at the instance of the revenue, for the benefit of the revenue to make the assessment appropriately. So therefore, our job in issuing tax audit report, we have to draw this line in our mind very clearly. We are doing it at the instance of the revenue for the purpose of enabling the revenue to compute the process of assessing the income properly. And turn back and then after issuing report, help the assessee in filing the return of income. We can guide assessee. We can help the assessee. We can tell assessee this is how we will have to take up the positions, etc. But from the point of the tax auditor, we will have to be extremely careful to say our job is only to give the finding of the fact. If we see the tax audit reports of the yesteryears before including certain additional classes, they were only talking about the facts. There were no judgments at all. The recent days, this particular principle is slightly given a go by. Earlier days, column 1 to 32 of the tax audit report, everything factual. They are only supposed to say what is factual. We have to say this is the fact, that's all. There ends the matter. There were no instances of sitting in judgment, whether this is to be allowable, inadmissible, etc. We have to go only by the factual matters. So in giving the report on a factual matter, we will have to be extremely careful because nowadays the assessment takes different shape. Previously it was manual assessment, thereafter e-assessment. From 13th of August 2020, it has become faceless assessment. Everything the assessing may be genuinely doing, but in the past it is easy for convincing the officer going by the genuineness of the transaction. But in the faceless era, that may not be the case because assessee has to once again demonstrate the genuineness of the transaction, necessity of incurring that particular expense, etc., and with a proof as to how he has incurred that expenditure, etc. So the information sought to be verified by the department in faceless era is something different as compared to how it was done in the past. Therefore, our role in helping the assessee in filing the return, as well as our role in issuing tax audit report, we need to necessarily draw the line of demarcation and make ourselves very clear. Otherwise, what happens? The audit reports are now taken up for the purpose of sampling, etc. Department requests the income. Our institute to compile, to take audit reports and study where things really do not go good. And our institute proceeds further on collecting this information from the portal and gives advice to our members. More about it in the next few slides we will see. The quality of audit, institute is also very concerned that the government also would like to appraise the institute that they want to be very clear on this matter. And on the top of it, in case the revenue finds that the reporting made by the profession is not up to the mark, the misconduct can be reported through the departmental portal itself. Earlier it was not there. Now the portal itself, Income Tax Department portal itself has got the facility for the officer to say, this is the misconduct we have seen, therefore we are reporting it. It may thereafter take its process and the assessing officer can say something, the council can say something, the auditor can say something, but This is something which was not earlier available. Today it is available. Therefore, at least for that reason, we'll have to be a little more clear on what we would like to make it, give it to the tax audit, give it in the tax audit report, at the same time keeping enough documentation from our side to substantiate tomorrow if something is questioned, why we have reached that particular conclusion. So before issue of tax audit report, necessary documentation is to be kept on record. Similarly, before filing return of income, the assessee should be advised to have adequate information and documentation to support the claim, so that later on in a faceless era, a question comes, assessee would be able to demonstrate it better. Otherwise, at that time, the time would not be sufficient enough to demonstrate, and it will end up unnecessarily in addition, penalties, appeal, etc., which will be a costly effort in the days to come. Our institute early 2007 or so had this peer review popularized, and thereafter we had on the top of it quality review. Peer review is only to advise where things did not go good and just give an advisory. But quality review board is something it has already spent 10 more years, more than 10 years or so. And quality review board on financial statement audit takes the financial statement signed from the regulator side and start seeing whether accounting standard, auditing standards are properly complied with. Visit the chartered accountant office and just check whether all the accounting auditing standards were complied with, how they conducted the audit, what are the working papers they have, everything they start doing it in order to improve the quality of the financial statement audit. That's the job of the quality review board. And in case they find something not going good, they'll refer the matter to the disciplinary proceedings. The same concept of quality review board for financial statement audit was extended to tax audit itself. Taxation audit quality review board was constituted in 2018. Now what this particular TAQRB did, they have collected sample tax audit reports from the portal. As per the at the instance of the CBDT, they collected and they made a comparison with the financial statement filed with the ROC, financial statement attached with the income tax return, etc. And then they came up with good amount of literature as to certain errors are found. Some of them are very serious and material. Some of them are not so serious, not so material. In order to ensure that our members perform a tax audit without much error, they came out with one checklist, which is available in Word form as well as in PDF form of the institute website. And if it is picked up and every tax audit we start doing that through that checklist, that documentation will go a long way for us to demonstrate that our audit was done very well. Even if subsequently there are some errors, it is the assessee who did not do things properly, but our audit got conducted in accordance with the pronouncements of ICAI. In the May month journal, May 2021 journal, an article came up highlighting the major errors found by the TAQRB in scanning through the various tax audit reports issued by our members, and they have listed out certain errors which need to be taken care of. And page 36 to 41 of our ICAI May journal has got that article, and where they have been mentioning the errors as well as finally the concluding remark of the TAQRB go to say the taxation audit quality review board wherever finds material serious non-compliances, it may refer the matter to the designated executive for initiating appropriate action. However, if there are no material non-compliances, then there will not be a reference to director discipline, but appropriately that same will be brought to the notice of the auditor by way of an advisory. My request would be to go to this May 2021 journal, page number 36 to 41, and read all that particular 5 pages and see, 5-6 pages and see the important observations of the TAQRB in releasing the tax audit report. That would definitely help us, even if some of the matters where we have divergent views or some of the matters where we have taken a different view, how to reconcile it and give it so that tomorrow the institute would not take up that for tax audit quality review and then thereafter there will not be any nuisance value coming up to the member, because our members give so much of attention in releasing the tax audit report, and they could spend good amount of time. And subsequently, in 1 out of the 30-40 cases, something goes wrong and it results in subsequent consequential actions, etc. The peace of mind will be lost, and the member would be unnecessarily into trouble until he gets out of the problem. And therefore, better to review this literature given by our ICAI, and we see that we don't come across such things in our tax audit report, one. And also the checklist given by our institute will be very useful if we start following that checklist before releasing the tax audit report. Our institute website has got both PDF form and Word form of the checklist. TAQ or the page, if we go, we are able to download it. That may also be looked into before releasing the report concept. Now we'll get into the nitty-gritties of the provisions and the latest developments of the. In computing the business income, major controversy arises. One of the major controversies, I should say, arises out of valuation of inventory. So when the value of the inventory is made, which is something a judgment, the quantum is something which is factual, but the value is something which is judgmental. So when it is judgmental, definitely the value is open for questioning, challenge, etc. And interestingly, our accounting standard says when you value the inventory at the balance sheet date, it must be valued at lower of cost and NRV. Net realized value or cost, whichever is less. The principle here is, if it is taken for a cost, no issue at all. But why are we taking the cost or NRV, whichever is less? Why should we do it? Very interestingly, there is a Supreme Court judgment attempting to give a legal language for an accounting principle. Valuation of stock should be at closer at the lower of the cost or cost and NRV is something an accounting principle. For that accounting principle, the judge attempts to give a legal theory and understanding through legal language. In the debit side of the profit and loss account, we have the opening stock and purchases. If everything is sold at the end of the year, nothing is stock, you will have the same price credited to trading account. Opening stock and purchases are available. Everything is sold. Everything is the credit side of the P&L. The gap or the difference between credit side of the P&L and debit side of the P&L is the accrued income. So we don't have problem at all. But if some portion of the stock is not sold yet, that means your debit side of the P&L account has got some excess. But credit side of the profit and loss account only sold stock related sale proceeds are accounted. That means credit side there is something not balanced fully. Debit side is more, credit side is less. So what is more, to the extent of unsold stock, there is an excess in the debit side. That excess is sought to be reversed. So the judge goes to write, there is an excess on the debit side of the P&L. That excess has to be cancelled. When you want to cancel the excess, necessarily what is actually debited has to be cancelled. If I've debited to the extent of closing stock, its purchase value, that is excess. That means that purchase value has to be excluded. But he goes further to say, you have to cancel only the excess, nothing less, nothing more. You have to cancel only that excess, except where when you are attempting to cancel that excess related cost, you are very sure this much cost is unrecoverable. The cost of the item you acquired is 100, but you are very sure on this day that 100 is not recoverable. You can recover only 80. That means you already incurred loss. When you are cancelling excess, don't cancel at cost. You are sure that you are unable to recover the cost. Therefore, cancel at less than cost. So the principle given by the judge is this. The debit side of the P&L account or trading account, manufacturing account contains something excess on account of closing stock. That excess to be cancelled. When you are cancelling the excess, you should cancel only at cost. What is already finding excess in the debit side of the P&L account or trading account, manufacturing account. That much only it can be. Nothing less, nothing more. You cannot cancel more than what is debited. You can cancel something less than what is debited if there is a loss or expected loss on realization of that particular excess stock. This is the principle the judge tries to give. Very important principle to proceed further in very many cases if we have taken this principle clearly. Now, that's what accounting statement standards also say, ICDs also say, your cost or NRV, whichever is less, you have to value the inventory. That means if NRV is more than the cost, you will consider only the cost as the cancellation aspect. So what is debited is cancelled. If NRV is less than the cost, you are cancelling less, whereby your loss gets booked. Fine. Now, keeping this principle, we'll take up a couple controversial issues where the recent days what the courts have taken into account certain principles. The NRV, how will you justify it? Certain cases where a mere declaration is not sufficient, considering the facts of the case, where it's a cumbersome process, the SSE sought to provide a technical valuation report to support the NRV, whether that is acceptable. The courts have said yes, when NRV is based on a technical valuation report, that cannot be brushed aside. You'll have to accept. But mere declaration by SSE without giving any reliable data as to how that is computed in a subsequent case, how it is really established that NRV has got realization less than the cost, then without any reliable data, without any basis, mere declaration by SSE, something which is not acceptable. Now, in a seasonal industry, or for that matter any industry, the inventory periodically will become obsolete. When it becomes obsolete, for obsolete inventory, should we have to have only the cost, or can we downgrade it? If it has become obsolete, realization is not possible, then we can always downgrade it. Nothing wrong in it. But something one has to be clear about. Certain corporates, certain SECs, not necessarily corporates, have the policy of aging the inventory, and if it is fashion industry, etc., beyond a particular age, that fashion may not be appealing, and therefore beyond a particular age of the inventory, it may not realize as we expect the original value. So they downgrade the inventory. Say after 2 years, 50%, after 3 years, 40%, after 5 years, 20%. So as a policy, they will downgrade the cost. That becomes the NRV because you don't have a direct evidence of NRV. So they go with an aging policy and they'll consistently follow the policy. The aging policy is not something which is disturbed year after year, reframed year after year. It will go by, if it is gone by consistency, that aging policy is something which is acceptable. Nothing wrong in it. But again, if there are evidences to suggest that in the subsequent accounting period, certain items or substantial items are recovered by selling it at a price more than the aging policy, whatever they have fixed, then the earlier year computation may get disturbed. So if the aging policy followed consistently, and subsequent year also the actual realization in a substantial number of cases substantiate the policy by and large, then there is no issue at all. Then comes the date of ascertaining net realizable value. Balance sheet date, we have the cost. Net realizable value, whether it should be taken on the balance sheet date or at later date. That's the question before the Madras High Court. Now on the balance sheet date, let us say cost is 100, NRV is 110. Subsequently, let us say COVID related matters. Subsequently, down the line to 1 month or 2 months, NRV became 80. Now the SEC says on the balance sheet date, the NRV is 110, cost 100. But on subsequent day, cost is 100, NRV is 80. Whichever is less, I will take. For supporting this, the SSE went to the extent of fixing the board meeting of the company on that day when the market value was 80. They said on the date of adoption of the accounts by the board, the market value is only 80. Therefore, I will take only 80, which is less than the cost. But Honorable Madras High Court said this is something which is not acceptable. The scenario should support that on the date of balance sheet, there are indications to suggest your NRV is less. Otherwise, it is not acceptable. Otherwise, what will happen if this theory is adopted? What will happen? Whatever be the date on which the NRV is less, that is the date they will fix the board meeting date. And they'll say on the date of adoption of accounts by the board, the rate of approval of the accounts by the board, the NRV is less, therefore that has to be accepted. That concept is something which Honorable Madras High Court did not approve. So therefore, adoption or the comparison of cost NRV should take place on the balance sheet date, not something other than the balance sheet date. Balance sheet date cost, balance sheet date NRV. If it is not available 1 or 2 days, this or that way is permissible. Taking 3 months after that, etc., is something which is not so acceptable. If intervening date, if there are evidences to suggest that you have NRV data available more than the cost, then it is not possible to peg it down. Next controversy, which time and again used to come, would be whether valuing closing stock will have to incorporate the indirect tax component. While this is the reason why we had called the understanding what the courts have given about the reason for crediting the closing stock. That judgment clearly says what is debited for the acquisition to the extent remaining unsold should be cancelled by crediting to P&L. If while debiting to the P&L account, we have debited the cost net of indirect taxes, necessarily at the time of crediting the closing stock, we have to consider only net of indirect taxes. When the debit is net of indirect tax and credit happens to be more inclusive of indirect taxes, naturally what it suggests, we are inflating. We are cancelling something more than what is debited, and we are inflating the profit. To that extent, it is artificial, not realized loan, therefore it is not appropriate. Honorable Supreme Court said, if the debit happens to be net of indirect tax levy, credit ought to be net of indirect tax levy. It cannot be more. So that is something which we will have to be bearing in mind from the pronouncements of the Honorable Supreme Court. Next business related controversy would be embezzlement of cash. The real issue would arise in finalizing accounts of these cases where there will be some reports saying that cash got embezzled by either staff or director, when only some sleeping director, some active director, some employee director, etc. These are common cases. And when systems are not in place and the chances are given for with a weak system, temptation will always make people, very rarely people would be able to resist the temptation. Otherwise, when there is a need, and definitely these are cases where they are bound to be unless they regulated very well with a conviction, etc. So when such type of events are happening, the business houses tend to lose money. And sometimes it is not that year in which actually it has happened, it could be surfaced. It may be going on, teaming and lading practices, etc. At a later point of time, it would surface. So now, the controversy would arise as to the year in which it will be entitled for the loss. In 1 year, money would be lost, but it would be noticed in a subsequent year. Moment it is noticed, action would be taken, and action would result in partial recovery of money. Sometimes very negligible recovery of money, sometimes nil, sometimes more, and trust you will have to return whatever recovered more by selling the assets of the person concerned, etc. The controversy arises as to the year in which it is entitled for a deduction. Year of incurring that loss, year of understanding, or year of noticing that loss, year of ultimate quantification of that loss. What is the year in which it is entitled? That's the question. 1 year we have incurred loss, but it is not noticed. Then it is beyond comprehension to say how one would be able to claim that in that year when he did not even know that there was a loss. Very difficult. So year of loss and year of noticing the loss are different. Year of noticing the loss is something acceptable on human probability ground. One cannot be expected to know something which he is not aware of it. But when legal action started and there is a prospect of recovery, whether one has to postpone this to the year in which there is an ultimate quantification of the loss. Now, first, if the year of loss and year of noticing the loss are different, one cannot compel the assessee to claim this loss only the year in which the loss incurred because he was not aware of it. Only in the year of noticing the loss it will qualify for deduction, even though it was running for some time. Year of noticing the loss, the entire loss of this year, loss of yesterday's, can be claimed as business loss. Nothing wrong. The fact that it is challenged, actions are proposed to be taken or action underway, and there is a prospect of recovery of a part of this loss, whether that would dilute the claim of the SSE, answer would be no. Here, there is no need for SSE to wait for the ultimate quantification of the loss. The gross loss the SSE can claim in the year of noticing the loss. In a year in which there is an ultimate quantification by recovering part of it, in that year, whatever recovered can be offered as deemed income under section 41. Nothing wrong in it. So, year of incurring loss and year of noticing loss happen to be different. Year of noticing loss we can claim not only the loss of that year, also the year of yesteryears, if there is any. And there is no need to wait for year of ultimate quantification. In the year of incurring, in the year of noticing the loss, the gross amount of loss can be claimed without identifying or estimating the prospect of recovery and the quantum of recovery. That can be deferred, and the year in which actual recovery comes in, it can be considered as deemed income under section 41, subsection 1. Whether there is a necessity to claim, whether there is a necessity to demonstrate that some action is taken for the purpose of defending or for the purpose of making a claim of embezzlement of cash. This has to be seen on a fact basis. If the numbers are substantial and the other person has got means to pay, etc., and the assessee claims we have not taken any action for some reason, valuable reason, then the shadow of doubt will come as to why a person should leave it. What's the need for it? But otherwise, on fact basis, the amount otherwise recoverable is negligible and the amount required to be incurred as an expenditure for the purpose of recovering that amount and the other mental and physical economy which the assessee has to undergo, depute staff, legal action, etc. The assessee has taken a conscious call that it may not be workable to proceed, then action taken to recover this is not a mandatory requirement. But that cannot be taken as a principle by itself. On facts, we have to validate. If running into cross he has taken and he has got good amount of money, there is enough amount of prospect to recover, and then still if it is stated that the assessee has decided not to recover, there is a shadow of doubt. There would be some hand in glove, etc. Then one has to prove further as to why it was not decided to proceed. Some additional evidences are warranted, failing which there could be a shadow of doubt of hand in glove between assessee and the other person. That he has recovered subsequently, which is not reflected, so on and so forth. Investigations may proceed further, and therefore action taken or action not taken would not be the decisive factor to decide whether it's allowable or not. It should be purely fact based. Not taking an action is also permissible provided the facts are supporting the case. The next controversy is advances becoming bad. There are several instances where the assessee used to give advance, salary advance given to employees. That employee sometimes comes and says, sorry, I'm not going to continue, I'm going to get rid of. Whatever advance already given, if you want to recover, you have to hold him for no more time, for which you have to pay. Some of the organization in some cases feel, instead of paying more money for the remaining period, let us leave off the advance, because that quality of the work got deteriorated. It's not advisable to hold him any longer. So they say, get rid of. Now the salary advance is forfeited or salary advance is written off, whether it would qualify for benefit of deduction. One. Second is advance for giving raw for purchase of raw material, whether that is allowable as deduction. That some fellow who has given first piece of raw material is not up to the mark, and we asked for balance, partly had given and thereafter it is not worth proceeding, therefore it was written off. Then advance given for procuring machinery, whether it is an allowable deduction. A developer who purchases land and makes into plots and sells it, he gave an advance and subsequently found that the property is not worth proceeding because of the litigation, etc. He could not recover the money back on facts, whether the developer can write off this land purchase advance. Lastly, TDS receivable advance. So TDS receivable, we have to recover the forms of 2016A. That fellow gave us money, net of TDS. We have been pursuing. He neither paid money to Government of India, therefore he did not give 16A, nor gave the money back to us also. Now what is the point in it? So we have written off whether this will qualify. So these are all some sample examples which I have picked up in real life scenario we will come across, and how law would unfold in giving deduction of these losses. Advances given subsequently turned to be irrecoverable. First of all, this is something which will not fit into section 30 to 36 as well as 37. Section 30 to 36, this is not coming in. There is no specific reference. 37 talks about expenditure. Expenditure means you have to pay voluntarily out of your pocket. These are all advances recovering bad. That means they are losses devolving on assessing. It is not voluntary payment for incurring an expenditure. It is the losses devolving on assessing. When the actual outflow goes, it was not considered bad. Subsequently, it was declared bad. So at the time of making payment, it was not regarded as bad, and therefore it is not an expenditure. Then the section which could be used for this purpose would be section 28 itself. Profits and gains of business or profession shall be chargeable to tax under the head PGP. That's the enabling provision. Courts have said any loss incurred in the course of carrying on business would qualify for benefit. So, in the course of carrying on business, you do some transaction. That's a genuine, regular business transaction you are doing. In the course of carrying on your business transaction, you have done some transaction which is turned to be bad at a later point in time, in which case it will be considered as trading loss. So, salary advance allowable. For that, in the course of carrying on business, the transaction should be on a revenue account to qualify for benefit. If it is on a capital field, then subject to the exception provided in section 30 to 36, capital field related expenditure would not qualify. Consequently, capital field related losses also would not qualify. So, advance given for raw material revenue transaction in the course of carrying on business will qualify. Advance given for purchase of land by a developer who develops the land into plots or purchases and sales, etc., that becomes bad. It is in the course of carrying on business, no issue. But advances given for purchase of machinery, it is in the course of carrying on business, no doubt. But however, it is on capital field. Therefore, it's a loss on capital account, not entitled. We claimed as a normal deduction. TDS receivable written off. It is nothing but the sundry debtor balance. I have given a service for 1000 rupees. He gave me 900 rupees. He had to give me 100 rupees. I believed he will give TDS certificate. He did not give TDS certificate. He has to give me 100 rupees. I have claimed TDS on the basis of this balancing number. Since no entry in 26S, I did not get TDS refund from Income Tax Department. Now that means it is not TDS, it is only money recoverable from him. He did not pay to Income Tax Department. Therefore, it is money recoverable from him. So it is nothing but sundry debtor receivable becoming bad. Therefore, it will be eligible for deduction under 36(1)(7) itself. It will be eligible for reduction. It need not be regarded as a tax. Therefore, debit to P&L is not a tax debited. It is a receivable debited. A receivable which did not come, therefore it is charged. It will be eligible for deduction. So any loss in the course of carrying on business on capital field, not eligible. Otherwise, balance would be eligible for deduction. Next controversial area which one has to keep in mind would be depreciation. Section 32 dealing with depreciation. We have number of instances of issues cropping up in connection with eligibility of claim for depreciation and quantum, rate, first eligibility, thereafter quantum, then the year in which it is eligible, then the rate at which it is eligible. We have all interesting concepts coming up. And SSC used to take some adventurous propositions, or some peculiar facts pattern might have made the SSC to test the case. And very interesting propositions are coming up. So first example or first case which we need to discuss is the scenario of registering the vehicle in the name of the director of the company or partner of the firm, but however, by conduct, the assessee firm or assessee company could prove that it is the asset of the company or firm, as the case may be. By conduct, the margin money has come only from the assessee company firm's name. Loan taken, and loan, since the registration in the name of the director partner, the director will be the first applicant, company could be the second applicant of the HP document. Then subsequent periodical EMI goes only from the company's account or firm's account, as the case may be, and used the vehicle for the purpose of carrying on the business of the firm or company, as the case may be. If there are overwhelming evidences to suggest that the company or firm used this vehicle for its business purpose, and there are surrounding circumstances to prove that company or firm enjoyed the vehicle in its own capacity as owner, then mere fact that the registration stands in the name of a director or partner would not make the firm or company ineligible to claim the depreciation. The accounting entry suggests that the firm or company capitalized it, loan got reflected, periodical EMI paid. Then in all that case, and factually the assets are used by the company or firm for its business, then naturally the entitlement of claiming depreciation cannot be disregarded, or assessee cannot be said to be disentitled for claiming this particular claim. On facts and conduct, assessee is able to demonstrate this particular proposition. Business discontinued, but some assets are available. There are no businesses at all. 2 years, not even a single transaction, everything closed. But balance sheet continues to show block value positive. Whether depreciation can be claimed if all the 365 days the asset is not put to use, then it is not possible to claim depreciation. It's an adventurous proposition. Mumbai Tribunal said it is not possible to claim the depreciation because your business is already discontinued, you are not putting the asset into use, then claiming depreciation is not something which is permissible. But the business is ongoing. So we have 5 assets entered into the block. One asset is not at all put to use. You don't have orders to use that asset. You have orders only for 4 assets. After entering into the block, business keep going. It is not necessary that every asset must be used. It should not be used for anything other than business purpose. It is not necessary that every asset in the block must be used in every year. In the block, you have 5 assets, 4 assets are used, but business keep going, nothing wrong. It is not necessary that all the assets in the block are to be necessarily used in every year. But if the whole business is discontinued and there is no transaction at all, merely because block has positive value and asset continue to remain in the block, unused assets, it is not appropriate to make a claim of depreciation. Usually the assessee used to say, on 31st March, I should have asset, I should have positive block value to claim depreciation. That should be supported by the fact that he is in the business. 31st March, there is an asset in the block. 31st March, there is a positive value of the block. But at the same time, necessarily, the assessee should be in business. Only then the depreciation can be claimed. Generally, the assessee would tend to claim certain expenditure incurred on a rental premises as revenue in nature, so that 100% deduction will be allowed in year 1 itself. Revenue would like to classify that an expenditure on capital field, so that the assessee may either claim depreciation or make suitable alternative claim, but 100% revenue deduction not permissible. This is something where both assessee and revenue would take their extreme positions. Sometimes the assessee would go to the extent of claiming everything as current repair. Sometimes even small things, revenue used to say this is nothing allowable. It has to be capitalized and claim depreciation. You can't claim this as revenue deduction. 2 extremes are made on 2 different sides where we are unable to get a reconciliation, and 2 extreme expectations from the other side really results in most controversial issues arising out of it. Now, certain broad principles can be arrived out of this. 1. In a rental premises, if improvements are made And the improvements are such that a basic rule on the expiration of the lease period, that improvements can be detached, taken over by the lessee or its new premises. I've taken a premises on lease. I take for 5 years lease. I do something for my own business requirement. After the expiry of 5th year, I can detach it, take it over, and I'll put in some other place where I'm going to shift my business. Use this again, in which case they are capital in nature. There is no controversy at all. It is going to be capital in nature. But if they are such that it is not going to be detachable, the moment you start detaching it, it will be waste. The glass partition, floor partition or flooring, where definitely after you start detaching, it will be useless. You can't reuse it again. There is a very good case to say they should be considered as revenue. This is how the thinking process, Haveless India, all judgments went on to say, where the improvement is such that it is useless. Afterwards, you can't claim it at all. You can't take it away. Then it is good to call this as revenue in nature. But we will have to make one point clear. Law says only an owner can claim depreciation. He must be either partly or fully owner there. We have exception to this rule. First exception is explanation 1 to section 32. It says if a building is taken on lease and you start using it, in that building you make some improvement, and to the extent of improvement you are only doing improvement, but in the eyes of income tax law you will be regarded as owner thereof and you can claim only depreciation. So we'll have to be very careful. Section 32 explanation 1 says you should take a premises on lease or rent as the case may be. Continue the business in that. For your business requirement, you are improving further. To the extent of improvement, you will be regarded as owner and you can claim only depreciation. So now explanation 1 to section 32 is a rule, as an exception to the rule that you should be owner of the asset to claim depreciation. For that improvement, we are not owners. Our landlord building owner would be the owner. Nevertheless, the law says you will be regarded as owner, you have to claim depreciation only. Now, this is something which is again surfacing in the recent days in the courts. That when explanation 1 says on building improvements, you are the owner, why not you claim that as depreciation? Why do you go by revenue concept? Even if such improvements are something which are not detachable, which are something which cannot be removed, still we call it as capital in nature, and you can claim only depreciation. Is school of thought coming up by invoking explanation 1. And one has to be a little more careful in drawing the line of demarcation between this explanation 1 and the revenue repair, capital repairs or repairs which could be regarded as revenue in nature. The improvement should be something which should fit into explanation 1, failing which one can still say it is only on a revenue account. Otherwise, it is not appropriate to call it as revenue deduction, not eligible. The latest Madras High Court judgment tries to apply explanation 1 to section 32 and call it as a false ceiling made in a rental premises to suit your requirement can be regarded as capital in nature. But I personally feel these are certain things where after a particular elapse of time you start moving to some other building. The removal of false ceiling will not fetch anything. But your depreciation fixed for building at 10% WDV will take long time to claim. In which case the assessor's taxable income will be more than the real income what is left with him, and therefore the tax component will be more. This is where the assessors will be forced to do adventurous thinking. If the taxable income and real income tries to match each other, the idea of paying tax would not really hit large in the minds of the assessor. Assessor will be prepared to pay tax. But your taxable income artificially gets jacked up compared to your real income what the assessor feels. Then on that artificial income, assessor is asked to pay tax. The mindset of the assessor to become ingenious and adventurous starts. So this is one such area where at least there is at least these matters might not be appropriately to be classified as something falling under explanation 1, so that the assessor could have been given revenue reduction is what my personal view. But still, one should be careful in following these judgments which are regarding something which will fall under explanation 1, whereby one would not be able to claim there is a revenue reduction. Next disturbing judgment would be the Madras High Court judgment. Second-hand windmill purchased. Somebody purchased a windmill, used it, those days 80% depreciation, 20% accelerated depreciation, nothing available in WDV. Finally, 4 or 5 years later, that gentleman sells that windmill, some other person purchases it. Fact pattern of this case goes to say that the second-hand windmill purchased for 3 crore rupees and Canara Bank gave 2.4 crores or something as loan. Nevertheless, the officer said the other person has claimed 100% depreciation. You are once again claiming depreciation on this 3 crore. Therefore, I will consider the previous owner's WDV. The rest I will not allow. And the Canara Bank has advanced if the previous owner's WDV is only 5% because 80% he claimed. Those days he did not claim accelerated depreciation. So 20% for 5 years, the 20 on 80, 16 gone, 4%, so on and so forth. We take that value, what is going to be there and why Canara Bank should give that much loan on an asset which is worth nothing? That means the asset is worth. This point was canvassed, but unfortunately AO did not agree, CITPL did not agree, Tribunal did not agree, next High Court also did not agree. In my personal view, what went unnoticed is, in the year of sale of this particular asset by the previous owner to this assessee, the excess amount what he realized compared to WDV under section 50 anyway is paying tax, or he may have blocked to claim this. Since it gets reflected there, the assessee who purchases the second-hand asset should not be disturbed with this. Otherwise, explanation 3 to section 43 clause 1 will get attracted to every second-hand purchase. That's not the objective of explanation 3 to section 43 clause 1. Section 43 clause 1 explanation 3 says the idea of this assessee to acquire an asset which was previously used by somebody else is to claim additional depreciation which is not otherwise entitled to. In which case, the transaction value can be disregarded. The AO with the previous approval of the Joint Commissioner can substitute the fair market value of the asset concerned. That is not something which should be applied for every second-hand machinery, and every second-hand machinery one need not see what is the WD of the previous owner in order to ascertain the fair market value. Especially when the assets are purchased or in second-hand for subsequent use by unrelated parties. Obviously, explanation 3 should not apply, but this point also was placed before the Honorable Madras High Court to say transactions are with unrelated party. From unrelated party, for the sake of depreciation, why should you part with 3-4 crore rupees unwarranted? In spite of saying this was not accepted and the judgment went against the SC. Of course, it should be an aberration, but still, whenever second-hand machineries are sought to be acquired, better to have a valuation report or some sort of valuation to support the payment made, so that tomorrow this particular explanation 3 would not get triggered, would not land the assessee into trouble by substituting the previous owner's WDV and reducing the cost of this equipment. Purchase of a business in a slum sale, consideration paid over and above the tangible assets value. Can that excess amount paid be claimed as marketing rights eligible for depreciation? Marketing rights eligible for depreciation. But if the excess amount is something which is classified as goodwill, up to financial year 2000, March 2000, there is nothing wrong in it. It can be claimed as depreciation on goodwill also. Number of Smith securities onwards paid goodwill. Supreme Court said it is eligible. But Finance Act 21 said goodwill no longer would be a depreciable asset. You can, if you pay money to acquire goodwill, then call this as acquired goodwill, keep it as an asset, and when you sell it later on, claim long-term capital gain as the case may be, or short-term capital gain. But depreciation is something which is impermissible, is what Finance Act 2021 says, which one should keep in mind. Factory building will be entitled for 10% depreciation. If staff quarters are constructed inside factory premises to make the staff reside there, whether residential staff quarters constructed within the factory premises, nearby factory, etc., whether that will be eligible for depreciation at 10% or 5%. Our tendency would be to take the residential accommodation, why not be staff with 5%? But of course, this assessee went to the extent of saying it is only for the purpose of carrying on business inside the factory premises. Therefore, it is nothing but factory building. Therefore, eligible for 10%. Madras High Court endorsed this view. In my personal view, it is slightly adventurous proposition, but still we have one ruling. That type of assessees who are willing to take that adventurous risk, these sort of rulings can be used. But it is left to the assessee to decide how much one should really take that risk. POS terminals, we have seen in the restaurants to book the orders, etc., whether it should be regarded as plant, eligible for normal 15%, or it should be considered as computer, eligible for 60%. We have very interesting, like Delhi Tribunal judgment to say, it can be regarded as computer, and therefore it is eligible for 60% depreciation. Something very novel thinking emerging. So hoteliers, restaurant owners, those assessees can think of claiming this POS terminals as part of computer and claim 60% depreciation. And accelerated depreciation, 20% allowed for an assessee who is engaged in the business of manufacture or production of an article or thing. And he should be engaged in the business, but nowhere the law says the asset should be used in the same line. In that case, one exception provided there would be the road transport vehicle would not be eligible. Now we have transit mixer. Behind the vehicle, we have the mixer which is rotating and mixing the cement, concrete, etc. The assessee divided the cost. The primary vehicle cost separately, mixer cost separately. Primary vehicle is a road transport vehicle, therefore I will not claim accelerated depreciation. The transit mixer is a plant used for the purpose of carrying on my business, therefore that is not vehicle, and therefore that is eligible for accelerated depreciation. Ahmedabad Tribunal allowed it. So bifurcation of the cost of the vehicle into vehicle per se without mounting the transit mixer separately. Transit mixer eligible for accelerated depreciation. Novel thinking endorsed by Ahmedabad Tribunal, which again some adventurous can make use of. Then we come to deduction part of post depreciation. Will take up certain deductions. 11. Interest on belated payment of TDS. Good amount of controversy. TDS is something, is not my tax. It is somebody's tax. I am helping the government to collect his tax and pay to government. But government affiliate started making as if it is my tax and responsibilities. We are only doing the job of collecting tax of somebody else and remitting to Government of India to enable Government of India to collect the tax from him in an advanced fashion. We are only doing the job of collection and remittance. We are helping. But the way law gets complicated over a period of time, whether it is something which we are helping or it has gone to the extreme level of saying that it is our liability, is something which really one has to make a study. Now, the SSC says, I am taking money, I am deducting tax, I have to remit to Government of India. It is not income tax of mine. I have used the money for longer time. It is nothing but a fundraising exercise. I have paid interest to Government of India under 201(1)(a) or 206(c) subsection 7. Why not it be allowed as a deduction? It is nothing but payment. What is wrong with it? It is not my income tax. If my income tax, interest on my income tax, not allowed. Very interesting proposition. We have tribunal judgments saying why not it be allowed. We have Madras High Court judgment saying no, sorry. The interest should take the character of the principal to which it is calculated. The principal is TDS. And if you pay TDS and you don't recover, you charge to P&L, that is your debit, then it is not allowed. Since TDS is having the character of income tax, interest also should have the character of income tax. Of course, I am personally of the view that it is something where that reasoning is not so sound with due respect to the case. In Chennai Properties Investment case, that's it. But some assessees go to the extent of saying, I am collecting this money, or rather I am utilizing the money which otherwise I have to pay. So why should it not be considered as borrowing cost? Why should it not be allowed? Very technically speaking, we are not borrowing from Government of India, therefore 3613 will not come. What could be claimed is only 37. So it is not being personal, not being capital, laid out wholly and exclusively for the purpose of business, not covered under 30 to 36. Therefore, this should be allowed as deduction. One school, good school of thought, Karnataka High Court has allowed it, and we have few other judgments leaving it, and we have variations from either side. Therefore, we have to be careful in ascertaining the current trend at the respective jurisdictional high court, and accordingly one should plan. The next is the very interesting change came up in the Bombay High Court and the subsequent judgment, subsequent developments. One interesting case is this, where the assessee took a plea that in income tax, we pay income tax followed by the education cess. Thereafter, we are paying surcharge in applicable cases. The assessee said the tax portion is not a permissible deduction. Agree. Surcharge is not permissible because it is additional tax. Education cess. Earlier we have primary and secondary education, so now health and education cess. The assessee says the section 40 small a clause 2 says rate or tax. It does not say cess. Therefore, education cess is a permissible deduction. Gujarat High Court allowed it. Their matter came up to Bombay High Court subsequently. Subsequently, Bombay High Court also allowed it. Interestingly, in 2020, we received this judgment. We were very eager to see Finance Act 2021, Finance Bill 21, whether there is an amendment in 40 small a clause 2 to say rate or tax on income from business, including cess. Any some clarificatory amendment? Fair enough, there was no amendment proposed in the Finance Bill 21. So even today, the judgment of the Bombay High Court and Gujarat High Court hold good. Now that means very interestingly, the education cess paid along with income tax is becoming a deduction permissible. Now, what are the controversies associated with and issues which we need to face? First, which year we should allow? Here, now we work taxable income, work tax thereof, work interest, also test, education cess, etc. Thereafter, we are ascertaining payable and we are paying. Out of that one component, namely the education cess, you store and claim it in the P&L, then the number will get cyclical. You would not be able to quantify it properly unless you go with an Excel formula. So only after making an Excel formula, you would be able to make it up. So now, alternatively, in a subsequent year can be claimed so that the controversy would not arise. In my personal view, it is not appropriate to make a claim in a subsequent year because the amount is discharged either in the current year by way of advance tax or TDS, unpaid portion is discharged by way of self-assessment tax. But the amount is due in the very first year for which it is quantified. You may have to use Excel formula to break the circular reference, but you will have to ascertain it, no doubt. So year for which we are paying is the year in which we should pay, not the year in which it is paid. Number one. Now, if the assessee is a tax audit assessee and the self-assessment tax is paid after the due date for some reason, 43B will come because we would like to say it is a tax, but eligible tax. According to 43B, if the payment is not before the due date of furnishing return, it will be allowed only in the year of actual payment. So, self-assessment tax paid after the due date may not qualify even if you quantify in a computation of total income. Sometimes there will be ED addition to tax, addition to taxable income, addition to tax in the post self-assessment. Those claims can be made in the year in which it's actually paid. Subsequently, we get a refund. In the year of getting refund, to the extent of education cess already claimed, we have to offer under 41 subsection 1. What happens to all the earlier years? We have not claimed at all. Substantial amounts were paid. What happens to all those cases? Wherever, for whichever year appeal pending, those years, wherever appeals are pending, even though at the time of filing the appeal, a ground was not given in the grounds of appeal, an additional ground can be filed, and all cases for all the years wherever the appeals are pending, either before High Court or before the tribunal or before CIT appeal, one can make a request to accept an additional ground and claim this, even though assessee has voluntarily offered, officer has accepted without making any addition on this matter, then still a fresh claim can be made for the first time in any appeal proceedings at any stage, and one can get refund after getting an order from the CIT appeal or tribunal or the High Court, as the case may be. Nothing wrong in it. Now, this is something where I thought at least there would be an amendment in the Finance Act 21 nullifying the judgment of Sesagova Limited, whereby the refund would not come. But quite strangely, that has not happened. Therefore, even in all the appeals pending at different level, we are making claim, and the tribunal started allowing it. And of course, CIT appeals started allowing it. And therefore, wherever assessee has got appeals, in the appeal files, we can add this as an additional ground and get the benefit of this judgment of Sesagova Limited, whereby the education chess already paid may be claimed as refund. Deduction, consequentially, refund would be possible. Then payment by check on the loss today cleared in a subsequent period. Of course, today, by and large, all the payments have become almost by real-time process, NEFT, RTGS, etc. But still, some of the cases, some checks are issued in some other revenue legislature as well. In some of the cases, even today morning, I did a case for where when SSC has paid check on 14th of March, and the bank has sent it for collection. It took some time, and thereafter 17th only it got cleared. And as he said, I have paid on 14th itself, so that advance tax is paid, no 234C or B, or 234C. But the court, the assessing officer did not agree, and matter traveled to court. And court said, since the SSC has issued check and bank has given a certificate, subsequently it is not dishonored. Date of clearance is irrelevant, and it is the date of issue that makes the sense. So therefore, the check is issued on a day, but clearing takes place at a later date, but sufficient balance is there. There is no disallowance or dishonor of the instrument. Then the year in which check is issued to be eligible for deduction, it is not necessary that it has to get cleared. That's the reason why we have the concept of BRS in accounting. In the year of actual disbursement of the check outside our account, we should allow it as deduction. The other party might not have encashed it. That should not debar this SSC, so long as there is adequate bank balance and the instrument is not dishonored subsequently. That's what the Kerala High Court said, and we have today morning also on advance tax matter, another judgment has come reported in today's morning, which can be used. It should not be taken as a practice mechanism, but in a defense mechanism where people have already lost a case, one can make use of this. Then comes labor welfare dues. This is one thing which has become the bone of contention between SSC and revenue. 43B vis-a-vis 3615A. What happened? Originally 3615A said employee related welfare contributions you receive, you should pay before the due date of the respective statute, failing which permanently will not allow. For employer contribution also, originally the same was the position, but subsequently law was toned down. For employer contribution will allow in the year in which you pay, or in the year in that year's due date. If you pay, we'll allow it, no problem. But employee's contribution, it will be allowed only within the due date of the respective statute. If you pay, failing which it will not be allowed. Some adventurous SC said 3615A below. The explanation says the due date for this purpose will be the respective statute's due date. 43B says the employer contribution shall be allowed in the year of actual payment or due date of that year. But 43B says notwithstanding anything contained in any other provision, the 28 to 43. 1. Section 2, clause 24, subclause 10 says employee contribution is the income of the recipient, namely employer. That means moment I recover money, it becomes my income. Later on, if I remit, 3615A is the enabling provision to remit. But subsequently, it is controlled by 43B, because 43B says notwithstanding anything contained in section 28 to 43. 1. Second, 43B says employer contribution. That means moment I collect it, it becomes my income by virtue of 22410. When I remit, it takes the character of employer contribution, and therefore I am entitled to claim it as so long as I pay within the due date of filing return. These sort of arguments were accepted by revenue, by SSC, by various courts. Argument of the SSC was accepted. There are 3 judgments sent against the SSC. Kerala High Court in 2015 itself, and Gujarat Road Transport Corporation, very detailed judgment. Gujarat High Court, latest Madras High Court went against the SSC. On some other states, we have judgments in favor of the SSC. Now we have amendment in 2021 finance. What does it say? This amendment for the removal of doubts deemed to be all that. 43B shall not contain 3615A. 3615A cannot be claimed under 43. Now the amendment is prospective, but it is coming with a clarification, deemed always be all that. Now confusion comes. Though it is effective from Finance Act, by the Finance Act 21, effective from April 21, does it apply for all past cases or it will apply only for the current cases post amendment? We have two Hyderabad judgment, ITAT judgment in the month of May saying amendment is prospective. So those states where the state high courts have said employee contribution could also be claimed along with employer contribution as per 43B provision, this tribunal judgment may help them to say amendment is prospective, don't disturb previous years. But these three high courts where the high courts have already said it is not eligible, the amendment whether prospective or retrospective will not make any sense for those controversies because already it is stated that it is not allowable. Amendment only fortifies the view unless and until Supreme Court reverses the judgment of these three high courts. Then for past periods it may not be covered because this amendment can be regarded as prospective, in which case for past years the judgment could be favorable. On the current year onwards it would be something which is not permissible. But all said and done, this is something where why should an income tax law worry about regularizing the event in some other law? It's something which is someone should really think about, right? The income tax law should get complicated. We have respective legislature having powers to regularize the events in the respective law. If somebody doesn't pay PF law can trim him and see that he gets regularized. Why should income tax law worry whether he should pay PF or not? Why should income tax law worry whether he has to pay income ESI properly or not? Why should income tax law worry whether MSME interest is paid or not? Even if interest is paid, it will not be allowed. We have legislature separately to look after that. We have people to administer that legislature. And if the SSC is doing something wrong there, let it get penalized there. And anyway, we have income tax law to say penalty is not a permissible deduction. Why the payment itself should not be allowed as deduction? So TDS, if TDS is not returned, expenditure shall not be allowed. These are all some overreaching provisions of the income tax law, resulting in gap between actually earned income and the taxable income. And then the idea of the SSC to do some adventurous planning or some sort of activities to see that his actual income and the taxable income matches. To that extent, he'll start planning. So therefore, one has to be a little more at least wise enough to see that the sort of amendments are not resulting in making the SSC to stretch too much. Only then the compliance level will go up and it will be good for the SSC as well as revenue to focus productively. Otherwise, these sort of things would only contribute litigation and only nightmarish provisions followed by the litigations, and sometimes the resources of the country is getting wasted on a matter which is not warranted at all, is what I personally feel. Of course, larger, higher wisdom should work on this subject to make the law simple so that the business community will find it easy to proceed further on this particular subject. The next is a very important aspect, especially in a tax audit scenario, one should keep in mind. Cash payment exceeding 10,000 rupees in a mode other than cash. We have 48.3, Rule 60D, so on and so forth. Now, very interestingly, sometimes the SSC would say, I have not given cash, I have given check. But whether that check is a bearer check or a simple crossed check or an account pay crossed check matters most. We have a Gujarat High Court judgment to say a crossed check itself is not sufficient. It should be an account pay crossed check. A bearer check first straight away will not be eligible because bearer check you are asking your staff to draw, instead you are asking the other person to draw from your bank account counter. It is as good as cash payment. So bearer check is not qualifying for it. Crossed check you cross, but you don't say only that person should be entitled to draw. That can be endorsed and some other person can put that money in his bank account, that's instrument, and collect it. So I can write a simple crossing, give it to Mr. X, he can give it to Mr. Y, Y can give it to Z, Z can deposit in his bank account, and the Z bank account instrument will get forwarded to my bank account and give me a really crossed check payment. But I have paid to X, money is encashed by Z, so trail is not available. Therefore, Gujarat High Court said crossed check is not sufficient. We have to have account pay crossed check. So therefore, SSC giving bearer check, absolutely it is not eligible for deduction. Crossed check or account pay crossed check, now whether from the standpoint of the auditor, whether it is possible for us to say whether he has given cross check or account pay cross check, difficult. Because unless the original checks are handed over to the assessee bank. Normally in certain countries, banks do not preserve it. They scan and give it back to the assessee. The assessee possesses the original check itself, and it is possible to scan and then see that it's originally account way crossed and bank has given it, and then it is possible to say. Otherwise, it is difficult for us to comment upon it. Whereas sometimes it is possible. Bank statement itself would say payment by cash, to cash so and so. In that case, it is only a bearer check. One has to be careful about it. So, whether crossed check or account by crossed check, we can say the assessee does not possess information. Therefore, in our tax audit report, we can give qualification. Bearer check, at least we should do some basic documentation that we have cross-verified the bank statement and the bank book of the assessee, whether the party claimed as paid for, and the instrument along with the bank's narration or the particulars column. What does it say? Assessee says, I have given to XYZ and Co. But the bank statement says to teller or to cash, Murugesh. In that case, obviously what it would say, he has given only bearer check. Some portion of the bank book we should do documentation. Some sample period we can pick up, ascertain, and if the numbers are matching, no surprise is found, we can extrapolate it for the balance period. But some documentation to see that bank statement, bank book, there is no bearer check. We have to necessarily do that and keep it in our audit working paper so that it is for us easy to demonstrate that we have done our audit with sampling techniques as permitted by ICAI. Second is foreign currency payment. Something where I think disturbing ruling one has to take note of. One gentleman went to a foreign country for participating in a show, and in that he has taken some currency here and went and participated in the show. He purchased certain items for business purpose, brought back, and the expenses, exhibition expenses were accounted for. In that exhibition expenses, when you see he has spent in euro, how much euros he has spent, multiplied by the equivalent currency, the number in INR goes beyond 10,000. The SSC officer said, you have spent more than 10,000 in cash and therefore I will not allow. The SSC said it should be 10,000 euro. If it is less than 10,000 euro, you are not required to dissolve. After travel to tribunal, the SSC vehemently argued the word Indian rupees is not there and therefore 10,000 should be 10,000 equivalent in all the relevant currencies. But unfortunately, the tribunal said law cannot be expected to provide the name of all the currencies of the world, and therefore if it is INR, it is INR. 10,000 rupees or its equivalent. If you crosses that, disallowance is warranted, which I feel personally a disturbing judgment. But going by the spirit of the law, the revenue may say we would like to know the trail of who had received it. So long it is less than 10,000, we are not worried much. So if you say $10,000 or 10,000 real or 10,000 euro, the numbers are wide. And if something goes wrong without knowing the trail, then definitely something which is not acceptable for us is what the revenue would like to say. But still, whenever people take a foreign tour for business purpose and incur currency expense, this is something which one should take note of. The second is payment on a holiday or Sunday. Rule 60D provided an exception that if payment is made on a holiday or a Sunday exceeding 10,000, it will be permissible deduction. But quite strangely, from 29th of January 2020, this Rule 60D Clause J got omitted. For the last year, audit conducted for financial year 1920, if you have examined Rule 60D, payment made on Sunday, up to 29th January, any payment on Sunday will qualify. Thereafter, payment on Sunday would not qualify at all. For the financial year 2021, any payment on a Sunday exceeding 10,000 rupees, under Rule 60D Clause J, one cannot take shelter. Because on holidays also today, the transfer is permissible through electronic mode, and therefore this Rule 60D Clause J omitted with effect from 29th January 2020. Now, the famous and very interesting defense the SSC would like to always take is, I have ignorantly paid cash, but I am able to produce the person who received money from it. And he has also reflected it in his books of account. Then why should there be disallowance? The very purpose of 40A3 came is you are not able to show who has received money, whether he has reported that income. Trail becomes difficult. Therefore, we are restricting the number to a lower denomination. I have paid 5 lakh rupees in cash. The other person accepted 5 lakh rupees and he has reflected that 5 lakh, paid income tax. What grievance the government has got? There is no grievance at all. Why should I be penalized for that 5 lakh disallowance under 48? Is the defense generally the SSC used to take. And matter goes time and again to the court of law. And what courts have said, again, as a precaution, one should practice on this. Whether the genuineness of the transaction is a good defense to violate 48. Courts have said, sorry. There are, of course, I'm conscious that one Gujarat High Court judgment on P&H judgment and Delhi High Court judgment said the other person's PAN is provided, he has reported. There is no need for disallowance. But we have Madras High Court judgment in more than one case to say, sorry, genuineness is not the defense. 40A3 will come only for a genuine payment. If the payment itself is not genuine, you are not required to test under 40A3. You can test it under 36 and 37 and dispense there itself. A bogus payment need not be under 40A3 to be tested. A bogus payment is not otherwise eligible at all under 36 and 37. 30 to 36 will not qualify, 37 also will not qualify. Something which is otherwise qualifiable under 30 to 37, test it for 40A, 1A, 40A, 40B, 40 capital A, 40A3, etc. If it is genuine payment, you have to further test it. If it is ingenuine payment, you don't come under these sort of artificial provisions. Normal provision itself will fail. Then in that case, what needs to be done? Only thing is compulsion to make payment on the day. What business compulsion made the SSC to violate 48? If the SSC comes up with the compulsion, then we have a case. The SSC comes with a simple defense of genuineness. We have divergent rulings from various high courts. Honorable Madras High Court in more than one case said genuineness is not the base. It is the compulsion which you have to demonstrate. If you are unable to demonstrate what compelled you to make cash payment that day, then obviously you have no case at all. This Nadesh and Krishnamurthy is a very pathetic case. If you go to the facts of the case, it will show how pathetic it is. This gentleman, along with a few friends, he is a jeweler, along with a few other jewelers joined together, participated in a bidding process of one famous jewelers, pawnbroker who had taken jewels and paid money. Those people who gave the jewel did not return it, Malappuram Finance or something, or they did not return on a particular day. After several remaining days, they auctioned it. This Nadesh and Krishnamurthy participated in the auction. Some 30 crores worth of jewels were purchased with some 30 odd people, all joined together, but name was his. So he purchased it. Subsequently, they divided. Finally, he reported his share, hardly a very small amount. Whatever out of that jewels, old jewels, he has made some changes, he sold. Whatever profit he has reported. Suddenly, sometime later, those days when you make a sale exceeding X amount of an item where TCS is required to be reported, etc. In Nadesh and Krishnamurthy's name, that Malappuram Finance reported 30 crore as the sale made to them. Some reporting requirement, 285B. He saw it in 26 years, therefore wisely he thought it was a wise action to file a revised return before the end of 1 year from the end of the relevant assessment year. So after the financial year, within the time he filed original return, thereafter within the end of 1 year from the end of the assessment year, he filed a revised return saying, I purchased 30 crore rupees, I sold 30 crore rupees, except my share, the rest of them purchasing sales. I purchased from Manappuram, sold to my friends, the same rate, mad range. But profit remained what it was original. Now you see, on his earlier sale of 60-70 lakhs, he reported some profit. Now the sale has got revised in the revised return to 30 crore 70 lakhs, the same profit. What will be the net profit ratio? For normal profit, 2% on the jewelry, for 70 lakh rupees, you would have reported some 2 or 3%. Now that has become decimal. After you inflate both the side 30 crores. Now in that case, system picked up for scrutiny. Revised return was picked up for scrutiny. Officer asked for details why there is a gap between original and revised return. He said all these things. And he said, you are a purchaser of gold and seller of gold. You are doing business in gold. You purchased from Malappuram Finance and you paid 30 crore in cash. You have paid cash for purchase of gold. I remove 40A3, I disallow it. So debit side 30 crore got disallowed. He went to try CIT appeal, dismissed. Tribunal, dismissed. Madras High Court, dismissed. All along, the rulings of the authorities went to say he claims Malappuram Finance has accounted. It's a genuine payment. Therefore, it has to be allowed. But question is, what was the compulsion? What prompted him to pay only cash by collecting money from his own friends? What did, having decided they have to participate in his name, earlier day he could have collected all the money from his friends in check, and yes, he can say to Malappuram Finance evening 3 o'clock, he will transfer it if he is a successful bidder. Whether Malappuram Finance said by 3 o'clock we'll close auction 3:15, you have to give cash. Whether they insisted for it, there is no such provision or evidences to suggest there were compulsions. And therefore, the court said all the lawyer authorities are right in saying the assessee could not establish compulsion for making cash payment. Therefore, it is not a permissible deduction. So this is a very pathetic case where he has got only 2% on his purchase. For all his friends' purchase, the purchase cost is added now, and 30 crore rupees and 30%, imagine. And with interest, etc. For a person who has not made 10 crore plus will be the demand. You would not have made a sale of 1 crore rupees at the time, but 10 crore is the demand. What will happen to that case? Something pathetic. And therefore, it is a scenario where one has to really transact carefully. Otherwise, unimaginable consequences will follow. And the problem is the liability in the income tax law. Now, taking one step aside of this topic, this gentleman has 10 crore worth of tax dues. And he has got a business hardly every year doing a turnover of a crore, etc. He has been fighting. And up to High Court, he has lost. Assume for a moment in his name he has got one residential property, and that's the only residential property he has got. And since he has lost the case in High Court and is challenging to Supreme Court, how much he would be able to spare, etc. Question mark. If the department proceeds on recovery and puts his residential property in trouble, very, very difficult for the assessee. So therefore, when the person does a transaction of this volume, consulting is very important, failing which disastrous consequences will come. And the consequences will be such that all his past savings, all his past investments can be in trouble. Because today, the information is available that your demat account is available, your mutual fund investments available, above 50 lakh income returning assessees, entire asset schedules are available with the department, whereby it is easy for them to catch all this. And if these sort of undue extraordinary demand comes because of a technical ground, definitely it is going to hit the assessee heavily, which is something one should avoid by properly designing the transaction. Otherwise, it is going to be a nightmarish exercise, and this assessee should have sleepless nights. Similarly is the case for the other Madras High Court judgment. Therefore, 48(3) payment, one should be extremely careful when these sort of payments are made. And interestingly, when we are expected to report it in a tax audit report, how should we do it? Assessee made cash payment, assessee says these are all on business compulsion. Therefore, will not report it. What is our responsibility? In that clause, any payment of exceeding 10,000 rupees, what is that in that clause we are going to say? Primarily, let us understand, we are issuing Form 3CA or 3CB, and that 3CA or 3CB has got attachment of 3CD. Primary responsibility of furnishing the information in 3CD clauses is of the assessee. Our responsibility is only to verify the information furnished therein and say whether it is correct or not. That's our job. If the assessee says, I have made a payment for a business compulsion of exceeding 10,000, therefore I will demonstrate that it is business compulsion. Therefore, 48(3) is not applicable. I will not furnish that information. Now, in 3CD relevant clause, assessee says nil, but our audit procedure says there are payments exceeding 10,000. What we are required? We are not required to alter the clause of 3CD. It is the assessee who gives that. But on the correctness of the information, we have got a responsibility. So what we need to say, in para 5 of 3CB or para 3 of 3CA, we will have to say, in this particular class, assessee has made cash payment of rupees so and so on such and such date, but claims that on business compulsion and for relying on various judgments of various courts, this is not something required to be disallowed and therefore it is not reported. Therefore, the numbers are not furnished. Such a claim, such a mention is to be made in para 5 of form number 3CB or para 3 of form number 3CA. Our responsibility is to comment on it. If you are able to persuade SC to furnish it, if it is furnished, automatically disallowance will come and you will not be able to claim, because in tax audit report it is shown as paid in excess of 10,000. In the return, if he says, I am not going to disallow it, definitely under 143 subsection 1 clause A subclause 1 clause 4, the revenue would say we have compared in the processing of the return. CPC would say we have compared your tax audit report and the return. There is something which the auditor has suggested to disallow, but you have not disallowed it. Therefore, we'll add. Then there is a scope further to dispute. So, if the SSC claims these are on account of business compulsion, therefore nothing required to be reported under that clause, let it be 0. But what we need to say in para 5 of 3CB or para 3 of 3CA, we are required to report that these are the instances found in the books, but according to SSC, not required to be disallowed, therefore no information is furnished. That is something which we will have to take care as auditor's responsibility. That is taken care of, then there is no problem. Otherwise, as I already stated at the beginning of my speech, TAQRB, etc., all will fall in line and therefore you will have to unnecessarily face mistakes. Therefore, it is not advisable to give nil and also not to say anything in the tax audit report when factually the SC has made payment exceeding 10,000 found in the books. Forex fluctuations, we have two important things to notice. If the fluctuation comes on account of revenue transaction, even if it is not physically settled at the end of the year or physically realized at the end of the year, plus or minus, on mercantile basis, I have made a sale at particular rate, or I have made a purchase at a particular rate. At the end of the year, the rate has gone up and down. Because of restating, there is a plus and minus. Even if it is not physically settled or physically realized, the year-end restatement will be eligible for deduction or required to be offered as income. Blood Governor Limited, Supreme Court said, revenue transaction related fluctuation on mercantile basis you are entitled to claim. If it's a deduction also you are entitled, but it's positive you have to offer. That's all. Foreign exchange income. Foreign exchange fluctuation income. But if it is a foreign currency transaction on a capital account, not a revenue account, but a capital account, loan or a debt received in foreign currency. Now, you receive in foreign currency, but you use that foreign currency to acquire an asset outside India. In section 43A will come, year-end restatement on the loan. Blood Governor Limited, Supreme Court said, if you follow mercantile, year-end restatement claim whether or not it is actually settled or whether or not actually realized. But 43CA says, 43CA, it is 43A, section is wrongly typed. It is 43A says, year-end restatement on a loan borrowed in foreign currency to acquire assets outside India. Year-end you restate, but to the extent of the currencies you have actually settled for increase in the payment, claim this as cost of the asset. So I receive $1 lakh. This year I pay only $10,000 back. For $90,000 outstanding increase, I am not entitled on a mercantile basis. For a $10,000 I received at 68 rupees and now I settled at 69. That 1 rupee per dollar, what I've actually settled, that's actual outflow. That much you can capitalize along with the asset, fine. Now, peculiarly, the 43A says you have borrowed money in foreign currency. You have used that money to acquire asset outside India. Now, I have raised foreign currency loan, use that money for acquire asset outside, not outside India, but inside India. 43A will not apply. But this loan is borrowed outside India, from outside India to acquire a capital asset. Obviously, any interest payable, not interest, the fluctuation payable is on a capital account. Therefore, one would say it's a capital account entry, increase in liability used for acquiring asset, capital transaction should not be allowed. But quite strangely, we have two tribunal judgments, one high court judgment as well as one tribunal judgment go to say, very interestingly, 43A says loan should also be borrowed outside India, asset should also be acquired from outside India. If loan borrowed outside India but asset acquired inside India, 43A will not apply, will go by regular provision. Therefore, the increase or decrease in the foreign currency liability payable because of fluctuation, treat as revenue transaction. Allow it. This range, of course, welcome judgment. And quite strangely, these are the cases in ICDS. In ICDS itself, they say we allow it as a revenue reduction. Only to the extent of 43A, it is capital. Rest all revenue, knowingly or unknowingly, ICDS says we will allow it. And there are two judgments also to allow it. Therefore, if the asset is acquired outside India, out of the forex borrowings, their fluctuation need to be capitalized, not on a mercantile basis, but on a cash basis. The asset is not acquired outside India. It is acquired in India from out of the forex borrowing. Fluctuation need not be capitalized and need not be disturbed on cash basis. On a mercantile basis, the SIC otherwise follows mercantile basis, that can be charged off or recognized as revenue transaction. Now, year of survey, unlike search, in year of survey, certain things are generally not addressed for some reason or other. Therefore, I thought yes, an important checklist may be provided for this particular scenario. Search is having a very vehement outcome, but the survey is not that very. So they come to business on a business running hour, pay business, inventories, the stock takes note of the inventory, identify how much was the cash, but they don't seize anything. Books may be impounded for a period of 10 days, which could be extended subsequently. And some question statement, a statement would be recorded, questions would be posted, etc. And post such survey is over, end of the financial year is over, thereafter the assessee would file return. Generally in survey, some questions would be asked which may be relevant to business, may not be relevant to business, something personal, but still in the year of survey, something will go, and thereafter when the assessee post completion of the financial year furnishes return, one has to collect the survey statement, a statement recorded during the course of survey, and analyze the fact of that whatever they've supported or mentioned, assessee has deposed, and cross-verify. First one is, sometimes in the introduction part they'll say, what is the size of the family, what's the educational need of the family, son, daughter, etc. And where are they staying, all that they ask. Whether the drawings claimed in that year, whether it is considering the family size, etc., whether sufficiently soon, because they will say something orally, whether that should result in any undisclosed income used for personal drawings. That has to be factored. Then children study, in which standard they are studying, school, college, etc. Sometimes some questions ignorantly, as you would say. When one of the cases, as he said, my daughter is studying in medical college, second year, we have paid capitation, we have rupees this much. All that he says, which is nowhere relevant for a survey day, but still. So in that case, what will happen? In that year, if at all these statements are given and it is not subsequently retracted, the study expenses were adequately covered in the family drawing is something one has to see. Foreign tour expenses. What are the countries to which you have visited? He would say all that. So whether that has been properly factored is something which the assessee, at least in the year of survey, when a statement is recorded, we have to see. In real time, every year we'll have to see this, but at least in the year of survey, the statement will speak against the assessee after filing the return, because all survey cases, year of survey, mandatory scrutiny. So survey statement will be compared with the return of income. Whether all are factored or not, officer will check. Therefore, one has to be clear. Unlike search, where a cash is seized or returned, in a survey, they notice the cash, how much, but they don't seize, they'll return. Many occasions, we have seen our practical life, after the survey is over, on the date of survey, assessee will say, my books are incomplete, yet to be updated with various transactions for paucity of time, the account and not there, or some information did not flow from various areas to the accounting department. You can't rely on the book as such as complete. So whatever cash balance shown in the books is not correct. It could be less, it could be more. You have counted the cash from my chest. Whatever is the cash, that is the cash. I have to do reconciliation of various transactions. The cash will match. So generally they will write 7 days time will take to reconcile cash and submit. They don't do it because of various time, because anyway, if other offers are sufficiently covering up, these things will not be attended to. After that, they do all the reconciliation, etc. Year is over, finally, year end, all that other factors are taken. Many occasions we have seen, after updating the records, Again, go back to the date of survey. On the date of survey, what's the cash balance in the books after updation? What is the cash found during the date of the survey by the authorities? Whether both are one and the same. If there happens to be cash less after updation as compared to the cash found and returned by the survey team, to that extent of cash excess, it is undisclosed or unexplained cash leading to application of 69 series. If the cash happens to be less than what is shown in the books, that means to that extent of cash, books cash is more, physical cash is less, balance cash is taken in. And one can again, up to necessarily one has to demonstrate why it is varying, how that has subsequently been addressed. So cash found and returned after updation of records, one has to necessarily combine, verify before filing the return. Otherwise, this is leading to unnecessary disallowance or unnecessary addition under section 69 series. And all of us know 69 series will invite 115 BBE, and the rate of tax together with interest and penalty will go to 116%, which is something to be avoided. Then, similar to cash found and returned, excess stock found surrendered in the course of survey. What would be the consequence? Physical stock is taken, value is ascertained, and the incomplete records based on the previous year audited accounts, add all purchases, add all sales separately, give the margin for GP, arrive at the closing stock ought to be, how much is the actual stock available on the date of survey, do some valuation, difference, as he says, I'll agree. Now, question is, how do you conclude subsequently? Anyway, increase the stock will offer income, credit P&L, debit stock, with some reason. Now, there are so much of ramification if you close like this. Now, after crediting with some title in the P&L account, income offered during survey, additional income offered without using the land survey, credit P&L, debits inventory, inventory matches, agreed. Assay is not willing to dispute it. Now, after incorporating this, you ascertain your GP ratio. If the GP ratio for that year compared to the past year, there is a minor variation. Last year it was 22%, it is now 27%. Nothing wrong in it. This year your GP is 27, therefore this suppression of stock is only ascertaining out of the current year operation. But strangely, after you offer 4 crore rupees difference in stock to your current year income and you ascertain the GP comes up to somewhere about 78%. That means factually this is not income of the current year, suppression of the current year. Reasonable GP, to get a reasonable GP, whatever you offer, fine. To that extent, it can be business income liable for normal tax. Alternatively, if the GP is very high, revenue may say this is not an income of this year. It could be income of earlier year, but by mandate of section 69 series, asset found only in the year in which it is found, it will be deemed to be the income. Therefore, income not from this business, source not being explained. Automatically, when source not being explained, it will be treated under 69 series to the extent of that stock, which is resulting in abnormal GP. It can trigger application of 69 series followed by 115 BBE. This is what in a citation cited ICAI Surat, the view that it is nothing but stock in undisclosed business income, not business income because of overwhelming GP rate, undisclosed income from unexplained source, the action of the AO is accepted. Therefore, especially when survey takes place and the assessee surrenders stock on the belief that it's a current year business income will pay advance tax, matter ends there, is something one should not take it lightly. One has to be careful when the surrender takes place. If not, immediately after surrender, not on the day of surrender, one has to work out the valuation properly, whether there is incremental value, people have taken something with a double counting or higher GP instead of working out normal GP, higher GP for the ought to be stock. They have to calculate it so that stock value came down. One entry with GST, another one without GST, not properly comparing. These matters to be immediately addressed and a proper reply has to be given, failing which the excess may be regarded as not from current year business income, not resulting in income from disclosed sources, therefore resulting in application of 69 series followed by 115 BBE. and consequently penal consequences will come. Is something which one has to keep in mind. Of course, these are something which considering very less utility and defer it. Chairman, other office bearers, can I take another 10 minutes? Is it okay if I can take 10 minutes, sir?
Yes, sir.
Please, sir.
Okay, thank you. Okay.
Yes, we can ask participants to, post their queries in chat box, Q&A.
And later on also, if time available, we will give mic also so that they can explain.
Okay, sir.
So firms assessment and partners assessment, certain recent developments worth taking note of. Foreign travel expenses. Quite strangely, some cases where we have seen where the assessee has made export to some countries, but he has traveled to some other countries. Now, the officer used to say, you have traveled to some other country for a pleasure trip and therefore there is no relevance to travel that country, we will not allow it. Courts have said you can go for exploring the market, new market you can explore, so long as you are able to demonstrate it is for business trip, etc., with a slight element of personal aspect getting disallowed, merely for the fact that you have gone to a country to which you have not previously exported, or during that year you have not exported, that should not result in the entire expenditure getting disallowed. Now, Karnataka High Court had a case where the assessing officer went to the extent of saying, on a travel, your visa was only a tourist visa, it was not a business visa, therefore I will not allow this deduction. But the SSA said, even though I could apply for a tourist visa for a shorter visit, my business purpose only got achieved by traveling to these query places, conducting meetings, etc. Where the court has said the purpose is to be seen, the purpose for which the SSA has gone, by fact is able to demonstrate. The visa granted by the other country is not a relevant matter. So, yes, because it has come from tourist visa, the expense need not be disallowed. Family members accompanying foreign tour, bone of contention between SSC and revenue. We have number of judgments on it, and therefore some courts have said we will allow if there is a business necessity. Some courts have said it is not a business necessity on facts, and therefore we will not allow it. It's only a personal expense. And if it is a personal expense, only the company, the SSC firm will get the expenditure disallowed. Fine, no wrong in it. But interestingly, one officer has gone to the extent of saying that wife accompanying to the husband traveling, foreign travel expenditure, firm had disallowance. The officer went to the extent of saying, I am not even worried about firm getting disallowed. The partner's spouse is getting enriched. She is not paying anything. She has traveled, she has got a benefit, but she has not paid anything. Why should it not be regarded as income in her hand? A novel thought. Section 2, clause 24, subclause 4 defining income says, any benefit or a perquisite received by a person from another person in which this person or his spouse has substantial interest. That means 20% or above. If it's a company, shares. If it is non-corporate, profit share. Then, to the extent of that benefit or perquisite, it can be regarded as income. Definition of income includes this. So the officer said, Madam, your husband is a partner in that firm, having more than 20%. You accompanied her for a foreign trip. Your share of expenditure shown in the P&L of the firm, which is disallowed subsequently, amounting to this much, which is nothing but income in your hand. I am adding it. By virtue of section 2, clause 24, subclause 4, this has been upheld by Madras High Court. So therefore, the assessee seeks to get the tax deduction in the hands of the partnership. Worst case scenario, in addition to getting the disallowed, it will be added to the income of the partner concerned. Instead of seeking that as a deduction, it is charged to partner's capital account. First firm is not claiming it as a deduction. Consequently, it is only a capital withdrawal. Partner will not be exposed to tax. Otherwise, what will happen? Not only the firm is getting disallowed, double disallowance. Firm's disallowance, partner's addition, partner's spouse addition. Therefore, in sometimes these sort of controversies, better not to take the risk so that you will not lose the case on either side. Only one time, at least we pay tax so that will the other time double deduction, double disallowance or double addition would not take place. Second is payment of interest and remuneration to the partners. Clauses in the deed. Much water had flown post 1992 on this particular principle because deed, the clause 40 small b says the payment should be authorized by and in accordance with the deed. That means authorized by payment, the deed should say it is payable and quantification should be mentioned. That is mean in accordance with. And sometimes we see people say it will be decided by the partner from time to time. Sometimes people will say at the end of each year it will be decided. These are all certain cases which will result in some disallowances because the deed should say the payment is authorized. It should say the quantification part, how it is getting quantified. It should not take the color that it is decided after the end of the year or at the end of the year. That will be giving a color that it is amounting to application of income rather than deduction as expenditure. And if the entire class of 40 small b dealing with book profit first 90%, thereafter 3,90%, etc. reproduced, nothing wrong in it. Courts have said, but that much we have to pay. Having said we have reproduced it, we give only part of it. Then the deed should say this is the maximum. Something less at the discretion of the partner, but to be decided at the beginning of the year should be allowed. We say discretion, but the discretion takes place at the end of the year, then it is again amounting to adjustment of the profit, which is not an acceptable proposition. Sometimes it will not be allowable. And all the more, in the faceless era, we are asked to produce the deed and supplementary deed, etc. And in which case, necessarily, before the finalization, before filing the tax audit report, before filing the return, one has to ensure that the amount claimed, whether adequate documentation is there. Very honest to say, post reduction of the scrutiny cases, filing of electronic returns, those days senior members would acknowledge that we used to file the return manually along with the certified true copy of the partnership deed duly signed by all partners except minors, and wherever there is a change of the deed, all the changed deeds will file. When you used to file that, definitely whenever we do some change, the true copy has to go in that year's return. So things were kept in order. When the returns became annexureless, and then changes are taking place, as you would say, I'll do a memorandum, I'll do a supplementary deed, I'll just prepare a resolution for it and it will be taken for granted, it is resolved, etc. But what happens at the end of the day? Documentation is missing. Finally, when the scrutiny comes, case is picked up and we go back and see what is the amount claimed, what is the available deed, etc. Surprises started coming in the recent days, especially in a faceless era. And therefore, let us make very clear, when we claim interest remuneration from partners in partnership income favorable to partner, let there be adequate documentation enabling such payment, quantifying such payment in order, so that later on in a faceless era that should not result in unnecessary litigation. Right? Then, can a person claim deduction against these interest and remuneration received from a firm? Yes, this is a business income. 28 class 5 says any interest, salary, remuneration, bonus, by whatever name called due to or received by a partner from a firm is chargeable under the head business. To earn this business income, you have incurred certain expenditure. Following mercantile system of accounting, received it. It is not received, it is due from the firm. Interest on capital, interest on current account, etc. Remuneration credited to the partner's current account in the books of the firm. To earn this interest, I have contributed capital. For contributing capital, I have borrowed capital from somebody else. For that capital, I paid interest. So when I am entitled to claim interest income, why not I claim interest on payments made? Nothing wrong in it. I have used my personal car. I have appointed a driver, and that personal car expense and driver expense not charged in partnership firm. But when I receive interest or when the interest is due or salary due, against that, I am claiming the chaffier salary, car, insurance, depreciation, subject to a portion being disallowed for personal if any. Why not it be claimed? Nothing wrong in it. So long as adequate documentation, genuineness of the expenditure could be proved, nothing wrong in it. Quite possible to claim it. But this claiming should not go to an adventurous level. Why? Certain assessee said it's a business income. Section 28 clause 5 says it's a business income. The partnership firm is engaged in a business. I am a partner receiving interest and remuneration from a firm. For me, it's a business income. Why should I not go under 44 AD? Just offer 8% of the interest and salary, claim 92% as deduction. I'll offer just 8% and pay tax thereon. Very, very suicidal attempt. CIT did not agree, tribunal did not agree. Latest Madras High Court endorsed the view of the Madras Tribunal, saying this is not permissible. Just saying I'll go under 44 AD, offer 8% is not something permissible. If you have physically paid 92% of your income, why 92? 99% of your income by way of interest on third party borrowing. You have received 12% from firm, but you have paid 15% because of urgency. Firm wanted capital. Firm could not really raise funds from banks because of some DSCR ratio, etc. So therefore, partners were compelled to pump in money for ongoing projects. Partners went outside, took loan from 15% from somebody and pumped in and received only 12% and also received salary. Now salary and interest put together used for servicing this 15% loan. You arrive at the gap. Gap happens to be only 3% of interest and salary received. Nothing wrong in it. You have been in a position to demonstrate. I've received salary this much, interest this much. Out of that, I've paid this much, balance only 3% left. I'll offer to income tax. But without having any actual spending, without having documentation to support that you have actually spent, going by the mandate of 44 AD and saying, I'll just offer 8%, don't ask me how I've spent 92%. Something very, very suicidal attempt. And all the more once we claim that to be actually spent or 92% is not offered 8%. How much you will take for your source to your capital account? Only 8% could be taken. That means remaining 92, you ought to have spent. The balance should not be available in your cash and bank balances. And if it is used for reinvestment elsewhere, section 69 series may crop up. And therefore, it is not advisable to take that step. Ananda Kumar case, Madras High Court categorically said it is not eligible. Then impact of 14 year, because when you borrow money to invest in partnership, that investment in partnership fetches interest income, salary income, share income. Out of the three, share income is exempt, other two taxable. So one source gives you both taxable and tax-free income. For earning this source income, we have incurred expenditure. Entire interest may not be eligible to be claimed against interest spent, interest claimed, interest earned from firm. Rather, a portion can be diluted by invoking section 14A. So therefore, 14A can be invoked if you seek to claim deduction against the income from partnership firm. So 100% may not qualify. A portion may get diluted, but fairly for corporate related earnings, dividend income coming, mutual fund income coming, 14A is sought to be introduced. Very rarely for a partnership firm, people are attempting, but recent days, income received from partnership by partner, 14A is sought to be invoked, which is also a recent one, which one should keep in mind. Company and shareholders, one important change is dividend has become taxable in the hands of the shareholder from 1st April 2020. We have to punch data based on the date of receipt of dividend. Therefore, 234C interest shall be properly factored. If that is not given, in dividend coming at the fag end of the year as interim dividend could be factored for total tax liability, in which case for the first installment itself 234C could come. Therefore, one has to keep that in mind when filing the return properly. And deduction on this dividend income statutorily restricted. You can't claim more than 50% of the dividend, 20% towards interest, and no other type of expenditure shall be permitted against this. But however, 14A can be spared for that matter. And of course, in deemed income, of course, good amount of litigations are there. Make only one point very clear. Previously, if the income, if the expenditure is claimed or a loss is claimed as deduction, in the year of receiving back any benefit or a refund of money, it will be chargeable to tax. If previously it is not claimed as a deduction, recovery year, it is not liable for taxation. It's something which one has to keep in mind. And I have taken more than whatever time given for the initial presentation. Thank you one and all for your patient listening and the opportunity given. And now I will leave it to the organizers to see the questions, if any, and based on the questions, we will proceed further.
Participants, any doubts, you can post your queries in chat box or Q&A box.
So till such time, even the organizers can ask some questions because it will require some commencement by somebody.
Yes. Sir, this builders case, builders.
Yes.
Now, certain notices are they are issuing like the unsold inventory.
Hmm.
What department says they have to show it as income from house property on a notional basis. The unsold property,
Yes, sir.
unsold
Not
flats. I'm talking about the builders.
Yes.
So, is a recently changed amended
Yes,
provisions.
sir. The provision, the original adventurous assessing officers took the view that the unsold flats have to be considered as deemed income, deemed to be let out, and therefore income is to be charged.
Yes.
Subsequently, what happened? The people represented. Therefore, the law got amended to say, from the completion certificate comes end of that year, and 1 year will give you time. Till such time, you are not required to offer. And thereafter also, if it is not let out or not sold, it means a good case that the chances of selling will be delayed. Therefore, we'll offer under deemed to be let out. So they have given a window period. Now, because of COVID last year, that time got further extended. So I think 1 more year got extended. Even thereafter also, if it remains unsold only, it should be considered as deemed to be let out. So after completion certificate is obtained, I think end of that year and 2 more years is now available.
Okay.
Thereafter, if it is still remaining as unsold stock.
Yeah, but this income from house property, the provision says if it is intended to let out, then only it will be applicable. If there is an intention to let out, but as a builder, they don't have any intention to let out because if it is let out, then we cannot sell it.
Absolutely.
Further. So whether we can argue that.
Section 22 says income from house property. Charging section 22 says annual value of building or land appurtenant thereto, of which the assessee is partly a owner, excluding that portion of the land or building used for the purpose of own business or profession, income from which is chargeable under the head profits and gains of business or profession, chargeable under this head. It is only annual value, not rent received. It is annual value. 23 goes to say how do you compute annual value, where it says annual value, rent received, receivable, standard rent and municipal valuation, so fair rental value, so on. So it should be annual value of the property owned by you.
Yes.
Whether your intention is to let out your own use or to leave it as it is, destroy tomorrow, that's all something which the law does not charge at the charging section. Annual value is what the language says. How do you quantify annual value? Go by the rules of section 23. That's the way that revenue tries to address one. So what could be the option? Assessee can explore. Okay, annual value. How will you compute annual value? Section 23 comes. 23 says if it is not let out throughout the year, why not we claim vacancy elements? If the property, if I'm owner of the property, my intention is to let out. But whole full 365 days, I don't get a tenant. Now, section 23 itself says if the property let and vacant for the whole or part of the previous year, for that portion of the previous for which it is vacant, annual value should be downsized. So you say after 2 years also I could not sell. That's an inventory lying beyond 2 years for some reason. You are invoking 22. Now I will go by 23. In 23, there is a provision to say if there is a whole year vacant, the annual value will be 0.
Yes.
That could be tried. Instead of saying government has given only shorter window period, beyond that also some cases stock remains. Why should I pay tax on notional income? Alternatively, one can say, okay, I'll also come under section 22. You are coming under 22. I'll also come under 22. Let us sit and discuss and work out mode of computing 23. 23 provides for vacancy elements. I'll claim vacancy elements.
Okay.
Thereby, the controversy could be at least brought to 0. Instead of saying that 22 itself is not applicable, this can be a way we can at least address that particular case.
Okay.
Question has come on tax liability for firms on reconstitution. I think it is Pratish Kapasi sir subject. Day before yesterday, Kapasi sir must have handled the issues on capital gains, right? Anyway, now interestingly, since the question has come, I will try to address that to the best extent possible, though it is not in relation to business, it's on capital gains. 45(4) underwent a change in Finance Bill, which underwent a change in Finance Act. In Finance Bill stage, the law went on to say, if a person 45(4) divided into 45(4) and 45(4) capital A, went on to say you give only cash or you give cash and property, how will we deal with that? All that was discussed at the bill stage. Subsequently, so much of confusion rather than what it attempts to solve, and therefore the revenue at the act stage rephrased everything. 45(4) A dropped, 45(4) continued with a different terminology. 9 capital B came into the statute. Now, question what we need to ask, on the date on which there is some change, whether the assets of the firm, either cash or immovable property or movable property, goes out. If the assets are not undergoing a change, asset continues to be the asset of the firm, whatever be the change, anything can be the change, but the asset doesn't undergo a change. In that case, the new law doesn't have any role to play. Nothing to say. But if the asset undergoes a change, that means if there is some change in profit sharing ratio, the existing assets are not undergoing a change. We don't have to worry about it. If a new person coming in, none of the existing assets of the firm undergoes a change. New person walks in and pays capital. In that case, there is nothing to worry. But if the existing firm, one partner walks out or one partner passed away, or there are much more changes in such a fashion that asset side of the balance sheet of the firm undergoes a change. Cash is parted with, assets are parted with, then imagine first, these are all certain things which in the law it was not very clear. In the rules they came up, and they came with a circular which is taking the character of a guidance note also, which how far it is binding. Again, the rule itself says any note circular given will be considered as a guidance. So first we'll ask ourselves a question. Now, I'm giving cash, no problem. Instead of giving cash, I'm giving, no problem means temporarily I'll hold it. Instead of giving cash, I'm giving an asset. Instead of giving an asset to partner, I'm giving it to third party. If I'm selling the asset to a third party, what all would be the cases? I'll sell a capital asset, or I'll sell a current asset, or I'll give cash to partner. These are the three possibilities. If I sell a capital asset to a third person, first I'll have to pay capital gains tax. Instead of selling to third person, get cash and giving cash to partner, I am giving the asset itself to the partner. Instead of selling the inventory to a third person, realizing the revenue and then giving the cash to partner, I am giving the inventory itself to the partner. I've already realized the capital asset, I already realized current asset, I've got a cash balance, that cash balance I'm giving to partner. These are the three possibilities one can eventually imagine. So now, in all these cases, when a current asset is sold, imagine first it is sold to third party, book the income. If it is sold, if this capital asset is sold, imagine it is sold to a third party, book the income, pay the tax notionally. Now, post-tax, there will be a net profit, profit post-tax, in which the retiring partner or a deceased partner also has got a share. Give credit to his account. So instead of giving an asset to partner, if you have sold to somebody, I might have got a capital gain, for which I have got a tax. Capital gain income minus tax is the amount of the profits finally available in the books of the firm, share given to the partner who retired also. Add to that. After adding to that, what is his capital balance? By whatever name you call it, capital account, current account, loan account, by whatever name you call it, aggregate. Aggregated number is with the fair market value of the asset parted with. If there is a gap, you are allowing the partner to enrich. So that enrichment, again you have to pay tax. So now two type of taxation. First, for parting with the asset, as if it is given to third party, apply the normal provision, capital gains tax or a business tax. Business income when stock in trade is given to partner. Normal. After giving credit this income in the P&L account, whatever is the share attributable to the retired partner or deceased partner, add to the capital account. How much is the total amount otherwise due? That amount and actual fair market value of the asset parted with or cash parted with, whether he is enriched or is not enriched. If the revised number and the actual disbursement matches, he has not enriched, nothing to worry. If the revised number is say 1 crore, but the fair market value of the land and building given, plant and machinery or inventory or cash aggregated number is 1.2 crore. That means only 20 lakh rupees is enriched, for which firm has to pay tax. And the irony here is he is enriched. He should be has to pay tax. Why should the firm pay tax where all other partners should have the bearing of it? Unfortunately, this is not addressed. So now firm is expected to pay tax on the money enriched by the partner concerned. This could have been made very simple, but unfortunately it was complicated to the maximum extent possible. And the question is, he got enriched. Whether he has invested 1 crore after all share of profit and the sale on asset, say profit on sale of asset added. He received 1.2 crore. This 20 lakh rupees, whether short term or long term? Question mark. That's where the rules further complicate to say the surplus you get, where from you get by selling this asset to him. What is the nature of the asset you are giving? If the nature of the asset is long term, this surplus is long term. The nature of the asset is short term, this surplus is short term. The nature of the asset is inventory, this is a business income. This is how the law proceeds further. And then if the assets thereafter in the block doesn't remain finished, the asset remains, you are already paying tax. Firm is paying tax on the 20 lakh. That 20 lakh you preserve, add to the asset. Later on when you sell, that much cost you will get so long as it is non-depreciable. If it is depreciable, add to the asset and claim depreciation at least. These are the broad principles. Section 45(4), Section 9 capital B talking about. But number-wise, if you work out, so much of interesting developments would come. But the understanding could be made simple by saying, instead of selling to third party, realizing and then giving to partner, we have given to the partner itself. So we'll divide the transaction into two. We have sold to somebody, realized, ascertained the tax, gave credit on this profit also to the account, then compared with what actually is received, whether there is a surplus. For that surplus, another round of tax. If you have this principle clear, I think the numericals by and large would get some clarity, although there are good amount of challenges in the numerical part of it. But principally what is attempted to be conveyed is something which we can fairly conclude on these lines.
Josh, I think nobody's having any doubt.
No queries.
Now, one more query has come, I believe.
It's very surprising because
Directly.
Ramnath sir or the Kapasi sir, yesterday even Jagdish Punjabi sir, I think these sessions were extremely very useful, and there has to be a lot of doubts or queries or questions, but very few. I think it's surprising.
Probably people would have felt all answered in the course of the presentation itself.
No, sir, I think you might have already experienced. No, earlier also, how many questions you might be receiving? You might have received earlier.
You got any queries, sir, directly?
I have not got anything except that first query which I have received on partnership.
Oh. If you don't have further questions, we can wind up. May request our immediate.
Josh, I think our chairman is there. I think why don't we just for the last 3 days we have not seen him. I think he's getting gradually getting well. I think he's having some. Sir, I think he's having some problem with his
Yeah,
Uh,
Ranjit texted me. I
uh,
said let him take rest.
Yeah, that's why he's
Good evening,
he's
sir.
Chairman, are
there.
you there? Chairman, are you there?
I'm very much here. I've been listening patiently, very
Yes,
happy,
okay.
taking notes, and though in bed, I think it is a personal treat for me for the 5 days that I can peacefully listen to all the
Great.
great speakers and
Definitely.
topics.
He is the most lucky person, I think, and simply sitting and listening fully. I think. Jose, I feel, I think the concluding remarks, I think Chairman can render, I think.
Okay, Chairman, then you can conclude, Chairman.
For somebody like Ramnath sir, I think it is not. It will be a burden on me to be giving a concluding remarks. That is the kind of fame, popularity, and acceptance he's been having across South India, especially for Ernakulam branch members. Somebody who's been very popular. So the moment we had Ramnath sir's name proposed, it was unanimous, to be frank, in our committee and across all senior members. So we are very thankful to you, sir, for having accepted our invitation and
Thank you, sir.
for addressing us very gratefully, sir, as usual in the past also.
Thank you so much. Stay safe, and let us reunite later on at a stage where we will be physically able to meet and share our feelings. Let us pray for it.
That's
So,
the process we have hopefully by November.